Hey, everybody. Welcome back to Arthur Invests. It's been a while, but I thought I would just set up a little time here this afternoon and chat with you about something that came across my desk this week. And a lot of the stuff that's going on in the country right now, a lot of talks about taxation and policy as the different members of Congress and the House think through how they're going to pull together some of these stimulus plans that we see in front of us. And so while I'm not going to pretend or even allude to the fact of that I'm not a political pundit, nor do I really care that much. I do like to follow this stuff because I think it's an interesting, it's just an interesting sense of topics to really see, okay, whatever side of the political aisle you fall on, left, right, center, somewhere in the middle, it's always good to kind of see where the puck is going and just kind of get a sense of things. But one thing that caught my attention earlier this week was this whole talk about a billionaire wealth tax. And so essentially the proposal on the table, and it sounds great on paper. I mean, it really does, right? Who could afford to pay more in taxes? And let's go after them, right? That's kind of the mentality, is like, these people have money. Why not? Let's go for it, right? It's just really this idea that we're going to go after them. And what we're seeing now is, of course, as they get closer, they realize it's actually fairly difficult to tax wealthy people. And so what I thought I would do is just kind of break down some of the reasons why it is a bit difficult to tax wealth. Okay, so let's talk about this. And I just wanted to share some thoughts that I thought was pretty interesting. So first off, why is it difficult to tax wealth? Well, the first is that, one, constitutionally, it may not actually be legal. So if you think about income is actually earnings, realized earnings that are creating a taxable event. And now I'm not a lawyer, but I will tell you something. Who is the people group in America that have the most resources to hire lawyers and to go to bat? Okay, so let's just say this actually goes through. Do you think for a moment this is going to get anywhere? I mean, this will be tied up in litigation for years, probably going to the Supreme Court, the best of the best lawyers. I mean, who could afford to fight this? This one group that you're trying to tax, and this probably isn't legal, by the way, so it won't even make a dent. Really, it's just going to cost a lot of legal fees, if anything. So that's kind of the first thing, is like, of all people, do you think they have the most resources to actually fight something like this? The second piece that I thought this was kind of interesting is, if you're going to go after a wealth tax, wealth is very, very difficult to measure. Because of course, people who maybe subscribe to this or clicking on this video, you probably realize that wealthy people don't have money in the bank. They're not typically very liquid. Assets are tied up in shares, vesting. You're going to have bonds, mutual funds, index funds, a lot of stuff that's in real estate. Especially if it's in real estate, you can't liquidate that very easily. It takes months. You got to have transaction costs. There's a lot of things you have to do to be able to get that to become liquid. Very few people just have several $1 million sitting in the bank. It's a very poor use of money, first off. But second off, it's just like your capital is not actually working. Usually the money should be working. Okay, so let's think about that. So they're not very liquid. So depending on the day, and me, I'm not even a multi-billionaire in any sense of the word, but we've done fairly well, right? We have a pretty good chunk of money in the stock market. And on a given day, right, we have a very big position in Amazon, somewhere, to the little bit south of $500,000 in Amazon. And in a given day, depending on how the market fluctuates, we could be up or down by $30,000, right? It just depends on how big of a swing it is. And if that's just one stock that I own, right, in our portfolio, could I let you just add another 2, 3 zeros, depending on when they actually measure the asset? That's the value. Well, what happens when the value goes down, right? Is there going to be a break for that? The other piece is it changes a little bit of the incentive structure, right? The idea of investing is you're taking capital, putting it to work with the understanding there's an opportunity for upside. I mean, you've already paid taxes on the money that you put in. And so it's not like the money's just free. It's not realized until you pull it out. So this would be changing that whole equation. And so how would property work? That would be another thing, is how do you measure real estate? Because you pay real estate taxes on that. So is it just like if you own over X amount of houses, or if they're rental properties, commercial, how would you quantify those assets? Because commercial properties value very differently than residential property. So it's very difficult to measure. And again, look, you have a boom year like we did last year. Well, yeah, your wealth went up. But if you have a crash or the market starts to subside, what properties do in Austin might be different what properties do in Bakersfield, right? It just depends on what market you're measuring. So you would have to have a whole group of auditors trying to figure that piece out. And again, you have to tax that. It'd be very difficult to measure. So that's another piece. It's a little bit of a moving target because one year you could be doing well and the next year it could completely swing. And the unintended consequences, say, for example, like a Jeff Bezos, if he had to liquidate his stock to pay, 20 billion in taxes or something, that would be enough shares of Amazon to potentially shift the value of the actual stock. And so that would impact shareholders, which would be very, very disruptive for the stock market. And so where would they put the money if they weren't invested in public companies? So it changes a little bit of the incentive structure. The other thing that I thought would be interesting is like, okay, so public companies are a little easier to measure. You could say, hey, we're going to go after your stocks because those are easy to see. You have X amount of shares in so-and-so company. You could see that value is this. Well, if I was a billionaire, I'd be like, well, let's just invest in private companies. Let's take it off the books, because with private companies, with tax deductions and other types of depreciations that you can take, you could easily manipulate the numbers and show very little taxable events there. And so you could actually make your wealth a little bit disappear, even though it's invested in other funds. So it's just not public. So that becomes another thing. The other thing I was thinking about is if I'm a billionaire and I have all my holdings in real estate or some of these stocks or something, well, just change the asset class. Then all of a sudden you move from something that's a little easier to measure like stocks, and then you put it into hard assets, collectibles like cars, machinery, art, things, or foreign real estate, right? Because you're going to just move it out of the country. Maybe you're buying houses and chateaus in France, which is not taxable in the US, right? You move it over there. I don't know how that would work. So you have a lot of ways to navigate that, or you structure different corporations so that you don't technically own those shares. Those shares go to a corporation that you can. There's a lot of ways to set it up to where like you will never get at these people. It's that doesn't make me mad, because the whole idea behind this was we wanted to try to go after generational wealth and dynasty wealth, and what they're going after is a lot of people in this top 700 category are typically folks who've created, at least in my philosophy, a ton of value in the US economy, right? You think about Tesla, you think about Amazon, and a lot of people want to be sour on Amazon, but they have, raised essentially the minimum wage in the country, giving people some great benefits. So of course I'm completely biased, but I'm just saying, like, there is a lot of value these folks have derived in the economy. And anyway, I just kind of point all these different things out. It's very interesting that, would be technically going after job creators and not necessarily the dynastic wealth that we were talking about, people who've inherited their money. Look, wherever you stand on the political spectrum, completely irrelevant to me. That's, you see, I lean a little bit more kind of center right, but I just thought it was kind of an interesting point, and I wanted to kind of share that out with you guys, get some thoughts. So yeah, very elusive, this mirage of taxing the billionaire class. I mean, is it possible? And also, is this a slippery slope, right? You say you want to go after the billionaires. They're a little bit more difficult to get, but what's not difficult is the high income earners, folks who make over $1 million or over 400 to 500,000 a year now seems to be the threshold. Well, that's a lot more people, and these folks have enough to do well, but not so much to be hiding and sheltering all the capital that they're making, because they're primarily making the money from their W-2 job still. So could a wealth tax be a little bit more easy to implement with some of the folks that are on the lower side of the wealthy spectrum? So interesting thoughts, potentially a slippery slope, or interesting dialogue altogether. So I thought I would share that with you. Hope you enjoyed it. Take care, and I'll catch you soon.